सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Those of you who track things like fixed deposits, bank deposit rates must have noticed advertisements, messages coming to you saying fixed deposit rates are going up. Please open a fixed deposit account. Your relationship manager, if you have one, could be sending you messages and mails saying the rates have gone up now. Please open a fixed deposit account in your bank. And this was, not long back, we were all wondering what is the point of depositing money in the bank when the returns are so low. That is because for a couple of years now, there has been very low credit offtake from the banks. People were not borrowing because they did not know what to do with the money they borrow. And when I say people, it's not like people like you and me. Of course, people like you and me too, but also industries, people who invest to grow their business. They were not borrowing, and that is because we know what happened with the economy in the last 3-4 years. A slowdown followed by pandemic, followed by lockdowns and all of that. But that has begun to change. In fact, that has changed so much. Bank credit growth has surged to a 9-year high of 15.5% for the week that ended August 26th. That is year-on-year growth, 15.5% year-on-year growth. At the same time, we have news coming that there is a liquidity deficit in the system, that there is not enough money and banks now have to mobilize money. That is why you're seeing all these ads for fixed deposit rates going up and people are asking you to open deposits. What is happening with credit offtake? Why is credit offtake going up? And why are we seeing this liquidity crisis is what we are going to discuss today with Radhika. Hello Radhika.
Hello.
Welcome to Macro Sutra. I'm YP Rajesh, managing editor at ThePrint. Radhika, 9-year high of 15.5%. How did that change? I mean, like I said, in the last 2-3 years, we were complaining that there is no borrowing going on and rates had fallen.
Yes, so we are seeing this resurgence in credit demand, which is happening over the last few months. And if we disaggregate one step further, bank credit can be categorized from the viewpoint of various sectors: industry, agriculture, services, retail. So retail segment was going strong for some time, but now what we are seeing is that even industry and services are also borrowing. They are also borrowing money from banks, and that is leading to a revival in bank credit. Now, from the services point of view, as there has been a revival in contact-intensive services because pandemic is moderating, so that is why we are seeing revival in travel, tourism, transport. So there is a demand for credit from these entities. Similarly, from industry, and which is a very encouraging feature that we are now seeing since 2016, the credit to industry was muted. In fact, it became negative in 2021. And now we are seeing an improvement in credit demand to industries, particularly large industries. So that is something that has changed very recently since May 2022. Before that, credit to large industries was actually flat, for 0%. And now we are seeing credit to large industries picking up, and which is what is also getting reflected in a strong overall credit demand.
So that's about 4-5 months old. The trend is about 4-5 months old.
Yes.
So among all these you mentioned, personal, services, industries, MSME, which is the sector which is growing fastest?
So the sector which is growing fastest is the retail sector, and that we can gauge from its share in the outstanding bank credit. Its share has been increasing. So its share was somewhere around 16 to 17%, and now it's more than 25%. The share of personal loan segment in the overall bank credit has increased. Now, within a personal loan or household or retail segment, as we call it, there are various purposes for which households or retail segment may borrow money. Now, that has also changed for the better. During the pandemic time, people were borrowing by pledging their gold. That has now changed, and we are now seeing that people are borrowing for buying consumer durables. They are buying for housing. So the purpose has also changed, which shows that initially or during the pandemic time, the borrowing by households was more kind of a distressed borrowing, which has now shifted to indicating revival in discretionary spending. So if there is more demand for consumer durables and people are borrowing money to buy consumer durables, it indicates a revival. It indicates, it bodes well for economic outlook. So that is one thing that has happened over the last 2-3 years. The other major change that has happened is in the industry front, and that's a story of the last 4 to 5 years. From 2016 onwards, what we saw was a period of deleveraging. In simpler terms, large industries or the Indian corporate sector started repaying its old loans because there was a crackdown on bank loans by more stringent regulatory standards for bad loan recognition. So when Raghuram Rajan became governor, he initiated something called asset quality review, which was a very stringent recognition of banks' balance sheets, recognition of banks' bad loans. So what earlier could be extended and pretended, banks had to reveal transparently their bad loans on their balance sheets. Alongside, we also had IBC, Insolvency and Bankruptcy Court coming. So in order to protect banks' balance sheets, this banks started taking corporates to bankruptcy court. So these were the reasons that propelled industries or large industries particularly to repay their loans. So that is number one reason. And secondly, then we had pandemic and there was low demand. There was collapse in both consumption and investment demand. So industries considered it more prudent to repay their loans rather than borrow more at a time when demand was muted. So, and now what we are seeing is that their balance sheet, their deleveraging is complete, and at the same time demand is picking up. So they have started to borrow.
And you, in your piece published on theprint.in this morning, you talk about, you actually contrast this with what happened in the US, where, companies in the US were borrowing heavily at low interest rates because rates had fallen during the pandemic. On the other hand, Indian companies were not borrowing. So what is this contrast? Why do you think these two different kinds of things happen?
So here, as I said, it was an outcome. It was due to the asset quality review and stringent norm. Also, what was happening was that because interest rates were low, companies were borrowing more from the bond market and using that money to repay high-cost bank loans. That was happening in India. And so they thought that this was a prudent strategy at a time when demand was low. Whereas what was happening in advanced economies was that governments gave money in the hands of people through expansionary fiscal packages, and at the same time interest rates were low. In fact, they were negative. So companies were borrowing. And they were borrowing even before the pandemic, and because of further slide in interest rates, companies started to borrow more. So that is why what we see is a huge surge in debt of advanced economies, both from the point of view of government, households, as well as companies. So much so that the IMF in its global debt database report has highlighted that this debt surged to 256% of GDP. That is massive. And a lot of that has to do with companies borrowing exorbitantly due to ultra low interest rates. So governments were also borrowing because they had to pay fiscal packages, and companies were also borrowing. Whereas in India, we saw a wave of repayment of loans, which in hindsight is it's a good strategy because now both for the bank side and company side, their balance sheets are much more better. What we used to talk about twin deficits, so twin balance sheet problem, that has more or less been addressed. and now they are ready to initiate a fresh wave of investments.
But we saw this headline today about liquidity sliding into deficit, and this is supposed to have happened for the first time in 3 years. How did that come about?
So that is again because now after pandemic, since last 2021, last few months of 2021, we saw the RBI changing its stance. During the pandemic, RBI and all advanced economies, central banks infused liquidity. That was the purpose of by which they were mitigating the economic loss caused due to pandemic. That is by providing easy liquidity. So there was easy liquidity through various tools. Banks were flush with liquidity, and then slowly when the economy started to improve and we were moving towards normalization of monetary policy, one of the tool to normalize monetary policy was to withdraw the excess liquidity with the banks. So from the end of 2021, the RBI started absorbing or withdrawing liquidity. So that has been happening, but it has happened at a very fast pace. If we look at last year during the same time, the surplus liquidity with banks was around 8 lakh crore, and now it has turned into deficit. So that means that there has been an outflow from banks. This means that particularly now, September, there is advanced tax outflows. RBI has been intervening, so that is also one reason. And banks are giving out more credit. So because of a confluence of all these reasons, we are seeing deficit, or banks are now looking for funds and they are borrowing from interbank money market, they are borrowing from Reserve Bank of India, they are borrowing through issue of certificates of deposit. So it all is again turning into a kind of a challenging situation and does pose a question on the sustainability of credit demand, because if banks do not have enough funds, they will not be able to intermediate into high credit growth.
Tell me something, Radhika, because over the last, say, 6 months to a year, when especially inflation started going up, one instrument the RBI used was rate hikes to reduce liquidity. The other one was they were doing all these operations without raising the rates to suck out liquidity from the system. So and within less than a year, I mean, we are in a situation where there is a deficit on the liquidity. I think a lot of short-term things seem to be happening. Inflation, credit offtake, this kind of a deficit. It all feels a little, short-term, isn't it? I mean, why can't we foresee these kind of situations?
No, it was already the eventual consequence of all these actions were to be that we will move from a surplus to something called a neutral liquidity situation. But it happened too fast over the last couple of weeks, and it may well be a temporary situation because when this advanced tax outflows period ends, there may be a comfortable return of comfortable liquidity. So Reserve Bank of India, as you mentioned, engaged in a number of tools like auctions.
There was something called VRR.
VRR, yes. So it is called VRR, Variable Reverse Repo Rate Auction. So in variable reverse repo rate auctions, banks can park their funds with RBI and RBI gives them interest rate. So that it was one of the tool to withdraw liquidity from the banking system. Now what RBI is doing, in fact it did yesterday, was variable rate repo auction, where it infused liquidity, it lent to banks somewhere around 50,000 crore. So these are tools are there in the toolkit of RBI to manage liquidity, and what we should expect in the upcoming monetary policy, some guidance on liquidity. Because that is very important in addition to rate hikes to address liquidity. What is RBI's viewpoint on banking sector liquidity?
Because that was my next question, because if you look at what's happening around the world, everybody is tightening their purse, rates are going up, the Fed Fed has just increased it by another 75 basis points. Next week is the monetary policy decision in India, and the talk is 50 basis point, another 50 basis. So if you raise rates again, what happens to your liquidity?
Yeah, so that is going to be a challenge, because if you raise rates because of higher inflation, then the cost of credit will increase, and whatever we are seeing an improvement, upsurge in credit, that will suffer. So banks have to have deposits, and they have to access finance through a number of instruments, which is what they are doing, and they should be able to do, because if we see many public sector banks have raised capital through the issue of bonds, through the issue of tier 1 capital. They have been raising funds. So if we have to see this wave of credit sustain, these things have to continue, and RBI also needs to support through liquidity measures. They will have to do that. Also, we should remember that we are getting into a season of festivals where there's a lot of consumer durable sales going on, auto sales, auto loan offtake, personal loan offtake. So if you increase rates like this, I mean, there will be some demand, but not as much maybe if the rates are lower. Yes. Let's take some questions, Radhika. We have a bunch of good questions today, starting with Mahendra Singh. Despite RBI's and the US Fed consecutive repo rate hike, our bank credit is growing, and even after that, our industrial sector is facing a slowdown as of now, especially MSME. Does that mean this growing bank credit will eventually turn into NPAs for Indian banks? So as we discussed earlier, the growing bank credit is quite broad-based this time. It's not just driven by any one sector. It's driven by services, it's driven by retail, and it's driven by industry. Coming to MSMEs, their share in the overall bank credit is very low. It's around 6%, and that share has remained stable. So even if there is some slippage where there is problems in the repayment of loan, that would not show up as a very big increase in banks' NPAs, given that now there is quite stringent monitoring of NPAs. In fact, in the latest financial stability report, we saw an improvement in banks' asset quality, and going forward also it is expected that NPAs will non-performing assets will fall below 5%. So the only pain point could potentially be MSMEs, but given that their share is very small in the overall bank credit, in the exposure of bank credit, it should not show up as a very big problem in the bank's balance sheets. The next question is from Pawan Sharma. He's asking if there has been a surge in MSME credits also, because the overall exposure towards SMEs has been stagnant at around 30 lakh crore for some time. Has this improved? So as I said, in terms of share, it has not, it has remained stable, but in terms of absolute numbers, in terms of absolute levels, we have seen an improvement in credit going to small and medium industry. We should also remember that during the Atmanirbhar package announcement, the MSME definition was changed. So a lot, apart from the total corporate sector, a big chunk now falls in the MSME category because the definitions have been liberalized. Many industries are now falling in the medium category. So that should also play a role. But in terms of share, it is stable. In terms of absolute levels, yes, we have seen a modest improvement since the end of 2021. The next one is from Aditya, very regular viewer with a lot of questions. Hello Aditya, thanks for your questions. Don't you think this credit surge also comes up with the risk of increased high interest cost, which may ultimately make the price of the product higher and lead to less demand in market? Inflation. Inflation. So right now, very interesting. In fact, we have plotted this graph for nominal bank credit as well as real bank credit. When we say real bank credit, it is just bank credit adjusted for inflation. And if even after adjusting for inflation, we are seeing an improvement in bank credit over the last few months. So as of now, inflation and higher interest rates have not adversely impacted credit growth. going forward, depending on the interest rate hikes, depending on whether RBI is following US Federal Reserve's trajectory of interest rate, how hawkish it is in terms of interest rate hikes, what is the position on liquidity, does RBI introduce more instruments for infusing liquidity. All these factors will shape the trajectory of interest rates and will in fact again shape the trajectory of credit.
It's a question from a YouTube handle which goes by the name of Let's Explore. So let's explore. The economy is facing inflation along with a tight monetary policy. What explains the rise in credit growth? Also, does the credit growth reflect an increase in investment expenditure or consumption expenditure?
So it's a combination of both, as what we are seeing is that from the investment side, the capacity utilization has picked up. Capacity utilization has actually reached its long-term average levels, pre-COVID levels. So capacity utilization by the manufacturing sector has exceeded 75%. So now when capacity utilization increases, there is a scope for fresh capacity addition because your existing capacity is being utilized. There is a scope for fresh capacity addition, which is what we are seeing in terms of new projects being announced. So CMI CAPEX database tracks new projects that are announced. It's a very useful proxy to assess the state of investment in the economy. And if we see that over the last 2 quarters or so, we have seen a big improvement in the new projects announced. In fact, around 12 lakh crores of new projects have been announced over the last 2 quarters. If we compare to the previous 2 quarters, it was 7 lakh crores. So there has been a jump which signals a revival of private investment. And if there is a revival in private investment, that would lead to increase in credit demand. That is one. The second is working capital requirement has also increased. Working capital requirement is like short-term requirement due to higher inflation. So that has also increased, which has led to increase in credit demand. And on the consumption side also, because households are borrowing a lot, it's around 16 to 18% every month we are seeing year-on-year change in credit demand by household. That means that they are also borrowing for consumption. So the data shows that credit demand has picked up for both consumption as well as investment.
Last question, Radhika, again from Aditya. Can we relate this credit surge with the anticipated market demand which the companies are anticipating because of festive season, which we just talked about? And what are the measures do you think the government can take or should take in order to surge consumer demand further?
So a lot of it is, yes, even banks are offering attractive deposits in anticipation of an upsurge in credit demand during the festival season. So a lot of it has to do with festive induced credit demand. Demand is picking up. If you see the GDP data, there we saw increase in demand. High frequency indicators are showing increase in demand. From the government side, as of now, we don't see any immediate steps. But if you look at the from the point of view of budget, there should be some rationalization of taxes or some reduction in taxes that will put more money, or in fact do not raise taxes and have more certain rational policies. I think that will help in keeping the consumption environment uniform rather than causing some pessimistic outlook.
Yeah. Thank you, Radhika. Next week is the week of the monetary policy, and we will try and focus Macro Sutra next week on what happens with that policy, what rates are changed, and what is the message that the MPC and the RBI will give next week. But until then, thank you for watching this episode of Micro Sutra. We will be back next week, like I said, with the RBI's policy.